Friends, thank you for being here today. We stand at a precipice of economic history, a moment where the tectonic plates of monetary policy, political pressure, and fiscal reality are grinding against one another to reshape the financial landscape for the coming decade. What if I told you that the stability of your currency, the value of your labor, and the future of the global financial system are being fundamentally altered by a technical switch flipped in the backrooms of the New York Federal Reserve, disguised under dense jargon to prevent public outcry? And how can we reconcile a stock market touching all-time highs with a central bank that is frantically patching the plumbing of a financial system that has seemingly forgotten how to function without a constant intravenous drip of liquidity? These questions are not hyperbolic exercises in fear-mongering. They are the necessary inquiries demanded by the events of December 2025. While the mainstream news cycle focuses on the superficial movements of the stock ticker or the political theater in Washington, a far more consequential shift has occurred. The Federal Reserve, the institution charged with the dual mandate of maximum employment and stable prices, has effectively signaled a surrender to a third and written mandate, the preservation of the sovereign debt market and the liquidity of the banking system. By analyzing the decisions made during the December 10th Federal Open Market Committee FOMC meeting and the subsequent actions taken on December 12th, we can decode a clear signal. We are witnessing the end of the post-pandemic fight against inflation and the beginning of a new era of fiscal dominance, where the central bank independence erodes, and the printing press becomes the primary tool to keep the government solvent. To understand the magnitude of this shift, we must first dissect the anatomy of the December 10th decision. On this day, the Federal Reserve concluded its two-day policy meeting with a decision that confused casual observers and alarmed seasoned analysts. The Fed announced a cut to the benchmark interest rate by 0.25%, 25 basis points, lowering the target range to 3.50% to 3.75%. Under normal economic conditions, a rate cut is a celebration of victory, a signal that inflation has been vanquished and the central bank can now afford to make borrowing cheaper to fuel growth. However, December 2025 is far from a normal economic environment. This rate cut was delivered into an economy that, on paper, appears to be running hot. Gross domestic product GDP growth for the second quarter hit a robust 3.8%. Unemployment remains stable at 4%, and the stock market is hovering near historic highs, historically. Rate cuts are the medicine administered to a sick patient, an economy sliding into recession or facing a liquidity crisis. Cutting rates when the patient is running a marathon suggests that the doctors see an invisible illness, or perhaps they are being coerced. This confusing backdrop led to what Wall Street has termed a hawkish cut. It is a paradox. The Fed eased policy by cutting rates, yet the internal messaging and forward guidance were surprisingly restrictive. This contradiction was laid bare in the voting record for the first time since 2019, and arguably reflecting a level of discord not seen since 2005. The decision was marred by significant dissent. The final vote was a fractured 9-3. The dissenters told the real story of the Fed predicament. On the hawkish side, regional presidents like Jeff Schmidt of Kansas City and Austin Goolsbee of Chicago voted to hold rates steady. Their rationale was grounded in the data. Inflation remains sticky, particularly in the supercore services sector. They argue that cutting rates into an economy with a government deficit approaching $2 trillion risks reigniting the very inflationary fire the Fed spent the last 3 years extinguishing. 8 out of 12 district presidents even voted against lowering the discount rate. A stark rebellion indicating deep concern within the system rank and file. Conversely, the dovish dissent came from Governor Stephen Miron, a figure closely aligned with the incoming political administration. He argued for a more aggressive 0.50% cut, ignoring the inflationary warning signs in favor of immediate stimulus. This 9-3 split is not merely a difference of opinion. It is a symptom of a central bank flying blind, due to the government shutdown that lasted until November. The Fed was forced to make these critical decisions with incomplete data. They relied on patchwork estimates and delayed reports, essentially steering the world's largest economy through a fog bank. This lack of clarity makes the decision to cut rates even more perilous, suggesting that the move was driven less by economic data and more by the need to prevent a systemic accident in the banking sector. Now, if December 10th was the signal, we must turn our attention to the mechanism unleashed on December 12th, the return of the money printer. 2 days after the contentious rate cut, the Federal Reserve Bank of New York quietly flipped the switch on a program that effectively restarts the engine of money creation. The specifics are crucial. Effective Friday, December 12th, the Fed began purchasing $40 billion per month of Treasury bills to the average citizen. This announcement was buried under layers of dense technical jargon. The Fed explicitly refuses to call this quantitative easing QE. Instead, they have branded it Reserve Management Purchases RMP. The official narrative surrounding RMP is one of plumbing and maintenance. The Federal Reserve claims that the banking system requires a certain baseline level of reserves cash held at the Fed to fund and smoothly. They argue that as the economy grows, the demand for these reserves increases naturally. Furthermore, they point to the calendar, the upcoming April 15th tax season, when citizens and corporations pay their taxes. Money leaves the private banking system and enters the Treasury General Account TGA at the Fed. This transfer drains liquidity from commercial banks. The Fed argues that purchasing $40 billion in securities monthly is merely a proactive measure to replenish these reserves and smooth out the tax season bumps. They insist this has nothing to do with stimulating the economy or monetizing debt. It is, in their words, just a technical adjustment. However, market realists and monetary historians see through this rebranding. Whether one calls it RMP, QE, or not Q, the mechanical action is identical. The Federal Reserve creates digital currency that did not exist previously. It uses this newly conjured money to purchase U.S. government debt from financial institutions. The seller of the debt, a bank or money market fund, receives fresh cash, and the Fed adds the debt to its balance sheet. The net result is an increase in the monetary base. The Fed attempts to distinguish RMP from QE based on duration. In traditional QE, such as the programs enacted after 2008 and 2020, the Fed bought long-term bonds, 10-year or 30-year treasuries, and mortgage-backed securities to directly suppress long-term interest rates and mortgage rates. With RMP, they are purchasing short-term treasury bills with maturities of less than 3 years. They claim this distinction prevents the inflationary stimulus associated with QE. This defense ignores the fundamental concept of fungibility in finance. When the Fed injects $40 billion a month into the short end of the market, it displaces investors who are holding those T-bills. Those investors now hold cash. They cannot generate a return on cash, so they must deploy it elsewhere. They move to slightly longer-term bonds, corporate debt, or equities. Thus, the liquidity provided at the bottom of the curve percolates upward, lifting all asset prices. By flooding the system with $40 billion a month, an annualized pace of nearly $500 billion, the Fed is turning on a fire hose of liquidity into a market already near all-time highs. This is not just plumbing. It is a stealth bailout of the bond market and a tacit admission that the U.S. government debt load can no longer be supported by private demand alone. I want to pause here and hear from you. Do you believe the Fed claim that this is just a technical plumbing fix? Or do you see this as a return to money printing and quantitative easing by another name? Let me know your honest thoughts in the comments below. Accompanying this policy shift is the illusion of a Goldilocks scenario, where official projections clash violently with reality. Alongside the shift, the Fed released the Summary of Economic Projections (SEP), the Fed quarterly dot plot and economic forecast. A scrutiny of these numbers reveals a jarring disconnect between the Fed optimism and the mathematical reality of the markets. The December SCP painted a picture of a Goldilocks economy not too hot, not too cold. The Fed raised its GDP growth forecast for 2026 to 2.3%, a significant jump from the 1.8% predicted in September. Simultaneously, they projected the unemployment rate to stabilize at a healthy 4.4%. Most surprisingly, they forecasted that inflation would continue to drift downward toward 2.4% in 2026. This combination of data points borders on economic fantasy. The Fed is effectively claiming that the economy will accelerate high GDP, employment will remain strong, money printing will restart $40 billion a month, yet inflation will somehow decrease. This defies the basic principles of supply and demand. If the economy strengthens and the money supply expands, demand for goods and services should rise, putting upward pressure on prices, not downward. The dot plot, which maps out where individual Fed officials see interest rates going, adds another layer of confusion, despite the rate cut in December 2025. The median projection for 2026 shows only one single rate cut for the entire year. 7 officials went even further, projecting 0 cuts for 2026. This hawkish forward guidance completely contradicts the market expectation of a rapid return to cheap money. Why would the Fed cut rates now but signal a freeze for next year? The answer lies in the political transition. Jerome Powell's term as chair ends in May 2026. The incoming administration, led by President Trump, has made it clear that they desire a more pliable, dovish Federal Reserve. Names like Kevin Hassett are being floated as potential successors. Economists who are expected to prioritize low interest rates to service the national debt over the fight against inflation. Powell is currently walking a tightrope by cutting rates and starting RMP now. He is attempting to prevent a liquidity crisis before he departs. However, by signaling one cut for 2026, he is trying to maintain a facade of independence and inflation-fighting credibility. But the market knows the truth. Once Powell is gone, the political pressure to lower rates will be immense. We are entering the era of fiscal dominance, where the central bank loses its independence. Because the government debt is so large that interest rates must be kept low to prevent national bankruptcy. The Fed is no longer guiding the economy. It is servicing the Treasury. So, what is the immediate consequence of this liquidity injection? It creates what we call a melt-up. Driven by crowding out and asset inflation, the immediate consequence of the December 12th money print restart is a dramatic, often vertical rise in asset prices that occurs not because economic fundamentals are improving, but because there is too much cash chasing too few assets. The mechanism driving this is the crowding out or portfolio rebalance effect. When the Fed steps into the market to buy $40 billion of Treasury bills, they are effectively removing those safe assets from circulation. The banks, money market funds, and hedge funds that previously held those bills now find themselves holding cash. These institutions have mandates to generate returns. They cannot sit on zero-yield cash, because the Fed has crowded them out of the safe T-bill market. These investors are forced to move further out on the risk curve. They look for the next safest thing, perhaps corporate bonds. As money flows there, yields drop and prices rise. Investors pushed out of corporate bonds move into blue-chip stocks. Investors pushed out of blue chips move into growth stocks. And eventually, the liquidity reaches the most speculative assets like cryptocurrency. This is a manufactured rally. It is a melt-up by design. We see evidence of this in the price action surrounding the announcement. However, the most telling signal is not in the stock market, but in the anti-dollar assets, gold and silver. Gold has surged to new all-time highs, and silver has broken the $63 mark, surpassing its inflation-adjusted highs. This is not a vote of confidence in the economy. It is a vote of no confidence in the currency. Smart money is realizing that if the Fed is printing $40 billion a month while the economy is growing, the value of the dollar is being systematically diluted. Foreign central banks and savvy investors are hoarding precious metals because they're the only assets that are not someone else's liability. They are the hedge against the debasement that RMP represents. The irony is palpable. The Fed claims RMP is to help the plumbing, referring to the repo market issues of 2019 when overnight lending rates spiked. They are terrified that without this constant infusion of cash, the banking system would seize up again. This admission reveals a fragile system, addicted to liquidity, unable to stand on its own 2 feet. The market is no longer a mechanism for price discovery. It is a vehicle for liquidity absorption. While rising asset prices may feel good temporarily, we must frankly discuss the ultimate price to pay, the resurgence of inflation and the slow death of the dollar. While the melt-up feels good for those with 401ks and brokerage accounts, the longer-term consequences of the December 2025 pivot are severe. We are setting the stage for a resurgence of inflation that the Fed may be unable to control. The transmission mechanism for this new wave of inflation is the Cantillon Effect. This economic theory posits that who gets the new money first matters. In this scenario, the primary dealers, big banks and financial institutions, get the new money first. They use it to bid up asset prices, stocks, bonds, real estate. The wealthy, who own these assets, see their net worth explode. They feel richer and spend more, eventually driving up the price of luxury goods and services. However, by the time this new money filters down to the wage earner, the average American prices have already risen. The cost of housing, insurance, and food increases before wages can catch up. This widens the wealth gap, creating a K-shaped recovery where the asset-earning class parties while the working class struggles with the cost of living. Furthermore, we must address the elephant in the room. The $37 trillion national debt. The interest payments on this debt have crossed $1.2 trillion annually, consuming a massive portion of federal tax revenue. The government is borrowing nearly $1 trillion every 100 days just to keep the lights on. This is a debt spiral. To pay the interest, the Treasury must issue more debt. But who will buy it? China and Japan are selling treasuries. The domestic private sector is tapped out. The only buyer left is the Federal Reserve. By committing to RMP, the Fed is monetizing the debt. They are printing money to buy the government bills. This increases the money supply, which inevitably devalues the currency. The dollar index DXY dropping below 99 is the market verdict on this policy. A weaker dollar means imported goods cost more, importing inflation directly into the domestic economy. The Fed projection of 2.4% inflation in 2026 is likely a march. We are already seeing core PCE personal consumption expenditure sticky at 2.8%. With the implementation of new tariffs which Powell dismissively called one-time price increases and the debasement of the dollar, the floor for inflation is rising. we are likely entering a period of reflation, where growth is nominal, driven by higher prices rather than higher productivity. Finally, we must widen our lens to witness the global verdict, the erosion of exorbitant privilege, and the acceleration of a multipolar financial order. The implications of the Federal Reserve December pivot extend far beyond the borders of the United States, sending shockwaves through the geopolitical landscape that could be even more damaging than the domestic inflation we face for decades. The United States has enjoyed what Valéry Giscard d'Estaing termed the exorbitant privilege, the ability to print the world reserve currency and purchase real goods from other nations with paper that costs nothing to produce. This privilege relies entirely on trust. The trust that the US dollar is a store of value and that US Treasury bonds are the risk-free bedrock of the global financial system. However, the institution of the December 12th money printing regime is a direct violation of that trust. And the world is taking notice. When the Fed prints money to buy government debt, it is effectively engaging in a soft default. It is paying back creditors with a currency that is worth less than when it was borrowed. Foreign nations, particularly major holders of US debt like China, Japan, and the oil-producing Gulf states, view this not as a stabilizing measure, but as a weaponization of monetary policy that forces them to subsidize American profligacy. They see a superpower that can no longer fund its military or its social programs through taxation or productivity, and instead has resorted to the printing press, a hallmark of declining empires throughout history. This loss of confidence is the primary driver behind the synchronized gold buying we are witnessing from central banks globally. It is not a coincidence that countries as diverse as Poland, Singapore, India, and China are repatriating gold reserves and buying the yellow metal at record paces. They are not merely diversifying, they are actively de-dollarizing. They are building a break glass in case of emergency parallel system. The BRICS nations' efforts to create alternative payment rails outside of the SWIFT system are no longer theoretical posturing. They are becoming a fiduciary necessity. If the US dollar is guaranteed to lose purchasing power due to the Fed ample reserves regime, then holding US Treasuries becomes a guaranteed loss for foreign central banks as foreign demand for US debt evaporates. The crowding out effect we discussed earlier becomes a vicious geopolitical cycle. If foreigners stop buying treasuries, yield should naturally skyrocket to entice them back. But the US government cannot afford higher yields because the interest expense would bankrupt the Treasury. Therefore, the Fed must step in as the buyer of last resort, printing even more money to suppress yields. This additional printing further debases the dollar, scaring away even more foreign capital, which forces the Fed to print yet again. This is the doom loop of fiscal dominance. The result is a fracturing of the post-WWI financial order. We are moving from a unipolar world, underpinned by the almighty dollar, to a multipolar world of hard assets and bilateral trade agreements. In this new paradigm, commodities, oil, gold, copper, food become the ultimate currency, while fiat paper becomes a hot potato that no one wants to hold for long. The United States is effectively trading its long-term geopolitical leverage for short-term market stability by choosing to bail out the bond market today. The Fed is sacrificing the dollar global hegemony tomorrow. The message to the world is clear. The U.S. financial system is no longer an open market, but a managed utility designed to serve the needs of the sovereign at the expense of the currency holder. If you are finding value in this analysis and want to stay ahead of these critical economic shifts, please make sure to like this video and subscribe to the channel. Your support is what allows us to continue decoding these signals and bringing you the truth about the financial system. So, where does this leave us as we look toward the future? Friends, The events of December 2025 are not merely a monthly policy update. They are a turning point. Friday, December 12th marked the day the training wheels came off the money printer, and the Federal Reserve blinked in its stare-down with fiscal reality. By cutting rates into a strong economy and restarting asset purchases under the guise of reserve management, the Fed has signaled that it prioritizes financial stability and government solvency over the value of the currency. The melt-up we're witnessing in stocks and gold is the market rational response to currency debasement. It is a flight from cash into anything that can hold value. But we must not mistake this nominal rise in asset prices for genuine economic health. It is a monetary illusion, fueled by debt and printed money. As we move into 2026, with a likely change in Fed leadership and a government that shows no sign of curbing its deficit spending, the guardrails are gone. The era of low volatility and low inflation is behind us. We are now navigating a world of fiscal dominance, where the only way out of the debt trap is through the devaluation of the dollar. The printer is running, the market is melting up, and the bill in the form of higher prices and a weaker currency is coming due. Prepare accordingly.